Have you ever wondered why it is that you're always hearing about central banks stocking up on gold? And why would they stock up on gold? What's the purpose? Is it because, everything's uncertain and, the economy's going to come crashing down, the world's going to go to hell in a handbasket? Or is there perhaps another reason that you've read so much about, central banks and other entities stocking up on gold? Well, like many things in life, there's no one set answer, but there really is something that makes perfect sense when you really think about it. So, again, if you haven't seen, there's been articles, videos, anything and everything regarding central banks buying up physical gold. Now, the first thing that people rush to think about, central banks buying gold is there's got to be a reason to it. There's got to be a method. And the reason is that, they see it as the currencies are going to end and they need a physical asset. No, that's definitely not it. Actually, the reason's much more mundane, and to a lot of stackers' dismay, it actually more proves the point that fiat currency is here to stay than anything else. So, last couple of years, again, central banks have added to their stockpiles of physical gold. Why would they do that? Well, in today's world, like it or not, the US Treasury really is the equivalent of gold. Oh, no, it's not. Physical assets are going to die. Fiat currencies are going to die. The US government is so in debt. No, forget all that garbage. It's literally the safest asset that you can have in a non-physical form. Now, US Treasuries, what people don't understand is, again, most of the debt of the United States is owned here in the United States. It's owned domestically. It's owned by hedge funds, investment funds, private citizens. The vast majority of it is here. Now, there are other countries, you constantly hear in the stocking community, oh, China owns our debt. Stop. The percentage of international debt that, is owned, it's not an issue. It really isn't. It's propped up as it's this big deal. It's really not. Now, that being the case, when you look at, again, how much debt the US really has, when you look at it versus the GDP, perfectly manageable. Now, again, a lot of the stocking communities probably their hands are wringing together and they're like, that's BS. You don't understand. You don't know. No, actually, I understand it pretty clearly. And that's why it's really easy for me to see the kind of through the BS. But back to central banks. Why are they buying gold, physical gold? Well, that's an interesting part of the puzzle. It's actually really straightforward. The reason that central banks stocked up on gold, especially during 2020 and, ever since then, is if you're using US Treasuries as your, safe asset and you're in a rising interest rate environment, that's not a good place to be, because those treasuries, while you're holding them, now a lot of them are longer term, but even shorter term, you don't want to be holding a bond of any type in a rising interest rate environment. It just doesn't make sense, especially if you can avoid it. So how do I get around that? Gold. It's a well-trusted asset. It's a, monetary equivalent to any type of currency. And it allows you to have something that's just as transactable as the US Treasury, but without the interest rate risk. So because of that, basically, if you don't understand how interest rates work, if you have a treasury, a US Treasury, let's say you have a 1-year US Treasury and interest rates go up ever since you bought yours, while you're holding it, the value of that treasury goes down. Now, as long as you hold it to maturity, it's not an issue. But if you're buying a 30-year treasury, you may not hold that 30-year treasury. You may sell it at some point. So if rates go up and you're holding one that's paying nothing, and the rates right now are in the fives, you're going to lose some money. That's it. It really is that simple. Why central banks stocked up on gold. Now, here's the interesting part, and the part that gets lost in the translation. Interest rates are projected to go back down. And why would that happen? Because banks, the central bank, doesn't like high interest rates. Surprise! They do not like high interest rates. Why? Who is the Federal Reserve? It's the big banks, JP Morgan, Bank of America, Citi. These are the banks that make up the Federal Reserve. They don't like high interest rates. Well, why wouldn't they like high interest rates, Chris? If they make more money, don't they make more money on, higher interest rate loans? No. In fact, it's quite the opposite. Higher interest rates basically mean that right now the Fed funds rate's in the fives, basically means that the banks have to borrow from the Federal Reserve at 5, lend to you and me at 8. Okay, it doesn't seem like that big of a deal, right? It is. Because having interest rates that high stifles people from borrowing. You know, if you don't have to borrow at 8%, maybe you won't. Whereas the game they were playing previously, and my opinion, they'll get back to, is basically borrowing from the Federal Reserve at 0, lending to you and me at 3 and 4, and making it seem like it was the world's greatest deal. Everybody wants to borrow at 3 and 4. And I assure you that when rates go back down, all of these loans that are being taken out right now are going to get refied back down to lower interest rates, which the banks love because they make money off of, refining those loans. This is the environment that we're in. This is the environment we're going to be in. And you got to be thinking about these things. What does that mean for gold and silver? What do you think it means? Lower price, lower prices. So if you haven't backed up the truck yet, you might want to wait a little bit longer, because as that scenario plays out, less and less demand for gold, especially from central banks. It's really easy to kind of read these things in advance. Now, does that mean some kind of a black swan event can't happen? No, it doesn't. But again, you want to play, the most likely hand. That is basically that gold and silver will go back down in price, especially gold. Not necessarily gold as far as in relation to silver, but on the central bank stage, that's going to be gold, not so much silver. Silver, just by itself, will go back down over time in spot. Is it going to happen overnight? No, but it's going to be a process. That's the thing. These are all the little simple things about this environment, about, precious metals, that gets lost on the community. They get caught up in the nonsense of, oh, there's a silver shortage and you got to get yours, or we're going to silver squeeze, or spot price is going to go through the roof because of this. No, it's not. No, it is not. It was a one-time thing with the big run-up post 2020. But like anything, like a stock, like anything, what goes up like that ends up coming back down to its normal price range. Now, that doesn't mean they're going to go back to $11 an ounce for silver. But will it go down to a more manageable price? Probably, most likely at some point. It takes time for things to, fix themselves and situate after a big move like that. But what does it mean for central banks? Less gold. Interest rates fall, gold comes off the books.